What's up, millennials? Today we're going to take a look at the valuation of a company called Joby. Joby is an eVTOL company that is going to focus itself on aerial ride-sharing, and this company is going to be acquired by the SPAC that's trading under the ticker symbol RTP. Before we start, if at any moment in this video I'm going to talk about a word you don't really understand, please check out my SPAC guide. It's going to be somewhere in the description beneath this video, and today we're going to be using method number 1. Also, if you want to have access to the Excel sheet I'm going to be using today, please go to our Discord. You can join our Discord by going to nesami.com/discord. You can then leave your name, leave your email address, and you're going to get access to it. And also, as always, don't trust me, verify me. I could be entirely wrong. I'm just a random dude on the internet documenting my journey. Let's first very briefly talk about what Joby is exactly. So as I've said in the beginning of this video, it is an eVTOL company. This company is focusing itself on aerial ride-sharing, so ride-sharing in the air, of course. And as we can see in the investor presentation, the Joby aviation vehicles are going to have a pilot, so they're not fully autonomous just yet. One interesting fact about Joby is that they acquired Uber Elevate, and that they, Joby, are also going to appear in the Uber app. And a little side note over here, because a few weeks ago we had a short seller report on eHang, and I remember they were talking about Joby as well. They said that Joby actually has a lot of people working there, that it is a very secure facility, that is very difficult to get into that. There are many great experiments as well. So it looks like Joby is actually an interesting company to look at. Now, I will say this because the person who said all this was Dr. Moore. He actually worked at Uber Elevate, so he is actually a little bit biased. With regards to a merger date, there is none just yet, but it is expected that it's going to close in Q2 of this year. Let's now talk about the pro forma valuation of Joby. As we can see, they started out trading at $10 per share, which is very usual for SPACs. We can also see that they're going to have 660 million shares outstanding after the merger. So that means we can already calculate the pro forma market cap or the pro forma equity value by simply multiplying these two numbers, and then you're going to arrive at a pro forma market cap of $6.6 billion. We can also see that they're going to have quite a lot of cash on their balance sheet after the merger, about $2 billion. So then we can already say, okay, we have this market cap of $6.6 billion. We've got this amount of net cash, almost $2 billion. Then we're going to arrive at a pro forma enterprise value of $4.6 billion. The thing, however, is if we go into TradingView, we can see that they are currently trading at $11.28. So that's the number we're going to put over here, $11.28. And that means that the current pro forma market cap is already up a little bit. So it is now $7.4 billion. And again, if you take off the amount of net cash, the current pro forma enterprise value is $5.5 billion. So based on a share price of $11.28, Joby right now would actually be worth $5.5 billion. All right, so now we know the pro forma enterprise value, but we want to know, first of all, the future enterprise value and then a fair enterprise value. Let's first talk about that future enterprise value. And to do that, again, we're going to be using method number 1 of the SPAC guide. We're going to use two numbers. First of all, we're going to use an EBITDA number, and we're going to apply a certain EBITDA multiple to that EBITDA number. Let's first of all talk about that EBITDA of a certain year. And for today's evaluation, we're going to be taking a look at the 2026 EBITDA. Very well. So in the investor presentation, what we can see is that they're not going to have any revenue for the next coming years. In 2024 is when they expect to have some revenue, 131 million. And then in 2025, it scales up. 2026, it scales up even more to almost $2 billion. But we can also see that they're going to have some EBITDA in the row over here. So of course, that's going to be negative for the first coming years. In 2025, they expect to have a positive EBITDA, and in 2026, a very positive EBITDA of $824 million. So that's the number that I put over here in my Excel sheet. Then we're also going to need some multiples to apply to that EBITDA of 2026. So what they do is they compare themselves with the multiples of other companies out there, other similar companies. First of all, they say, well, our own EBITDA multiple is 5.6x in 2026. But if you look at other companies in 2025, mind you, over here you can see that it's actually 2025. You can see all of these multiples of similar companies, some SPACs out there, some ride-sharing companies, of course, companies like Tesla, NIO, but also other companies like Disney, Netflix, and Tencent. I'm not sure if these companies are very relevant for this valuation, but it could definitely be something to look at. But you can see that the median of these companies is 35x. The median of these companies is 25x more or less, and the median of these companies is more or less 14x. So then they say, okay, very well, so we have those multiples. Then we can also take those multiples and we can apply a certain range instead of just one fixed EBITDA multiple. So based on the multiples we have been seeing for the competitors, they come up with a range of multiples of 25x on the low end and 30x on the high end. Okay, so we now have our EBITDA of 2026. We have our multiples as well. So then a calculation is going to be done by your Excel sheet, and it's going to be quite simple. The only thing that's going to happen is that it's going to take that EBITDA of 2026, then it's going to multiply that by the low multiple of 25x, and then you're going to arrive at a future low enterprise value of $20.6 billion. Then it's also going to do exactly the same thing for the high valuation. It's going to take again the EBITDA number of 2026 and multiply that this time by the high multiple of 30x. And then you're going to arrive at a fair future enterprise value of $24.7 billion. So then the midpoint valuation, which is basically the average of the low valuation and the high valuation, is $22.7 billion. So those are the future enterprise valuations. But we, of course, want to know what a current implied enterprise value is for this company, because this is for the future in 2026. So we now need two numbers to discount this back to the present. First of all, we need a discount rate, and we also need a certain amount of years to discount it back towards. Well, first of all, we know that these numbers are from 2026. We are living in 2021 and actually almost Q2 of 2021, which is when the merger is going to be closed. So that's why I put over here that the future valuation is for 2025.75, so that I can discount 4.75 years instead of 5 years in total. So that's one of the numbers we are going to need, 4.75. And then, as we can see in the investor presentation, they are using a discount rate of 20%, which is very standard for SPAC. So that's the number that you can put over here in your Excel sheet. And then you're going to arrive at these discounted enterprise values. So what it does, basically, what the Excel sheet does, and let's actually pull up a calculator. It takes, first of all, that low valuation of 20.6 billion, and it divides it, first of all, by 1.2 to the power of 4.75, because of the 1.2 stands for the discount rate of 20% here, and the 4.75 the amount of years you're going to need to discount it back from 2026 back to Q2 of 2021. And that is going to give you a current implied enterprise valuation rather of $8.7 billion more or less. Let's see if that's actually correct. Yes, it's exactly the same number as in the Excel sheet. And then if we do exactly the same calculation with the high valuation, so 24.72 divided by 1.2, the discount rate of 20%, to the power of 4.75, the amount of years to discount it back towards the present, you're going to arrive at 10.4 billion more or less in enterprise value for the high valuation. So then you have these discounted enterprise valuations for the present. This is the low one, this is the high one. So this is the midpoint enterprise valuation of 9.5 billion. Again, this is the average between this number, the low valuation, and the high valuation. So those are the current implied enterprise values, but we of course want to know a fair price per share. Well, the first thing we need to do is to go back to a fair market cap first of all. The difference between an enterprise value and the market cap, as we said in the beginning of this video, is the amount of net cash they're going to have on their balance sheet. And in the beginning of this video, we said they are going to have almost $2 billion in cash on their balance sheet. Now keep in mind though, that this amount of cash is going to go lower and lower over time, probably in the next coming years, because they're likely going to need this money to expand, to build production facilities maybe. So it's probably likely that they're going to have less and less cash over time. So keep that in mind. But again, if you take into account that they currently do have $2 billion in net cash, you can take these enterprise valuations, add back the amount of net cash, then you're going to arrive at these fair market caps. So for the low end, it will be 10.6 billion. For the high end, 12.4 billion. For the midpoint valuation, 11.5 billion. Then you can also say, okay, we have these market caps. Then you can also go to a fair price per share by taking those market caps and dividing them by the amount of outstanding shares after the merger, which is going to be 660 million shares outstanding after the merger. So if you take these market caps, divide them by the amount of outstanding shares, you're going to arrive at these fair prices per share. So for the low end, that would be $16.11. For the midpoint valuation, $17.43, and for the high valuation, $18.74. So based on these calculations, Joby currently is actually undervalued. However, as I said in the beginning, don't trust me, verify me, check what I'm doing, check if everything is alright. And also take into account, we have been taking a look at assumptions. We've taken a look at a predicted revenue, a predicted EBITDA. We've applied a certain range of EBITDA multiples. So if you change one of those numbers, the entire calculation is going to change and your fair price per share is going to change as well. With that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye.